take a quick look at your savings account. Do you know the interest rate? Because for most people, it's a rate that barely makes a dent, a rate that means your money is slowly losing its value. As of late 2025, the national average interest rate for a savings account is a tiny 0.39%. Now, you can find high-yield accounts from online banks offering much better rates, some between 4% and 5%. But many of the biggest, most traditional banks are still offering as little as 0.01%. On a $10,000 deposit, even a good rate from a high-yield account might earn you a few $100s a year. But when you factor in inflation, you're often just treading water, or even losing purchasing power. Your money is worth less tomorrow than it is today. Welcome to Generational Wealth, your pathway from knowledge to legacy. But what if there was a parallel financial system, one being built right now on the internet, that could offer returns your banks simply can't match? I'm going to explain why your next investment could be in decentralized finance, or DeFi. We'll break down what it is, why it's getting so much attention, and most importantly, the essential risks you absolutely must understand before even thinking about putting a single dollar in. So what is this strange new world of DeFi? The simplest way to think about it is this. DeFi is an attempt to build a global, open, and transparent financial system that doesn't rely on middlemen. It replaces institutions like banks, brokers, and clearinghouses with code. In traditional finance, if you want a loan, you go to a bank. The bank is a trusted intermediary, taking deposits from savers, lending them to borrowers, and keeping the difference. If you want to trade a stock, you use a brokerage. Every step involves a gatekeeper that takes a cut and sets the rules. DeFi changes the game by using smart contracts. Think of these as automated financial robots that run on a blockchain, most commonly Ethereum. These programs execute agreements automatically when certain conditions are met. Instead of a bank processing a loan, a smart contract can do it holding collateral, calculating interest, and distributing payments, all without a person or company in the middle. You don't access this world through a bank account, but through a crypto wallet. This wallet is your personal key to the system, giving you direct control over your own assets. This is a complete paradigm shift. It's finance that is programmable, open 24/7, and accessible to pretty much anyone with an internet connection. Okay, the tech is interesting, but why should you, as an investor, actually care? Let's break it down into a few big reasons. The first, and what gets most people's attention, is the potential for higher returns. Because DeFi cuts out so many middlemen and their costs, the returns generated can be passed directly to users. There are a few main ways people are earning these yields. One way is through lending and borrowing. Just like you deposit money in a savings account, you can lend out your crypto assets and earn interest. But instead of lending to a bank, you deposit funds into a liquidity pool managed by a smart contract. Borrowers take loans from this pool, and the interest they pay is passed on to you and other lenders. Because the process is so efficient, the interest rates, or yields, can often outpace traditional finance. In late 2025, it's not uncommon to see stablecoin lending yields on established platforms like Aave in the 2% to 7% range, with occasional spikes much higher depending on market demand. Protocols like Aave and Compound pioneered this space, creating huge decentralized money markets. Another method is providing liquidity for decentralized exchanges, or DEXs. Most DEXs, like Uniswap, don't use a traditional order book, and instead use automated market makers, or AMMs. These are just giant pools of two different tokens. When someone wants to make a trade, they trade directly with the pool. The people who deposit tokens into these pools are called liquidity providers, and in return, they earn a portion of the trading fees. This can be a powerful way to generate passive income. The third way is staking. On many blockchains, you can stake the network's native token to help secure the network. In return for performing this service, the network rewards you with more tokens. And with liquid staking protocols like Lido, you can stake your assets while still getting a tradable token in return, so your capital isn't completely locked up. Beyond the returns, another profound idea in DeFi is financial self-sovereignty and control. This might sound a bit abstract, but it's one of the most powerful concepts. When your money is in a bank, it's technically a liability on their balance sheet. They have the ability to freeze your account or limit transactions. In most of DeFi, you have self-custody. This means you, and only you, control your assets through your crypto wallet's private keys. No one can block your transaction or seize your funds without those keys. This offers a level of financial freedom that has never been accessible to the average person. You are your own bank. That simple idea is at the heart of the DeFi revolution. It's about removing dependence on third parties and giving power back to the individual. Finally, we have to talk about accessibility and innovation. The traditional financial system is filled with barriers. You often need a bank account, a good credit score, and to be in the right location. DeFi, for the most part, is permissionless. Anyone with an internet connection and a wallet can access these services. This has huge implications for financial inclusion, potentially bringing modern financial tools to people all over the world. DeFi is also a hotbed of non-stop innovation. Because most protocols are open source, developers can build on each other's work, creating what many call money Legos. One protocol might handle lending, another trading, and a third insurance. A new developer can then come and build a product that combines all three into something totally new. This pace of innovation is something traditional, siloed financial systems struggle to match. We're already seeing the tokenization of real-world assets like real estate, the integration of AI to optimize investment strategies, and big improvements in making DeFi easier to use. Now, before you get too excited, we need a serious reality check. The potential for high returns always comes with high risk, and in DeFi, these risks are very real. First is smart contract risk. The code I mentioned? It's written by humans, and humans make mistakes. Bugs or vulnerabilities in a smart contract can be exploited by hackers, who can drain all the funds from a protocol. This happens, and it can mean a total loss of your investment. Security audits help, but they don't eliminate the risk entirely. You also must consider market and volatility risk. The crypto market is famously volatile. The value of the tokens you're earning yield on can drop dramatically, very quickly. A high APY doesn't mean much if the underlying asset loses half its value. This is a fundamental risk you have to be comfortable with. Then there are rug pulls and scams. Not every project team is honest. A rug pull is a scam where developers attract investors and then disappear with the money. In 2025 alone, hackers and scammers have stolen billions, with some incidents involving fake platforms or elaborate phishing schemes. You have to research the team behind a project and look for transparency and a proven track record. Finally, there's user risk and regulatory risk. In DeFi, being your own bank means you're also your own security. Lose your private keys, and your funds are gone forever. There's no customer service line to call. Fall for a phishing scam, and your wallet could be drained in seconds. At the same time, the regulatory landscape is evolving. Interacting with certain protocols or addresses could expose you to legal risks, as governments can, and do, issue sanctions against entities in the crypto space. If you've listened to all this and are still intrigued, the key is to start slow, small, and with a focus on education. First, get a reputable non-custodial crypto wallet. Think of this as your new account for the DeFi world. You must learn how to secure your seed phrase. That's the master key to your funds. Next, use a well-known, centralized exchange to buy a small amount of cryptocurrency and send it to your new wallet. Don't start with your life savings. Start with an amount you are genuinely okay with losing, maybe $100. Then, start by interacting with the most established blue-chip protocols. These are projects like Aave, Uniswap, or Lido that have been around, manage billions in funds, and have been battle-tested. You could try lending out a small amount of a stablecoin on Aave to see how interest works, or swapping 2 tokens on Uniswap. The goal isn't to get rich overnight, but to learn the mechanics in a relatively safer corner of the market. Traditional finance is offering returns that struggle to beat inflation. At the same time, this new world of decentralized finance is being built, offering a chance at higher yields. It's giving you total control of your money and driving incredible innovation. But this isn't a free lunch. It comes with major risks, from faulty code and wild market swings to outright scams and the heavy burden of being your own bank. Your journey into DeFi should be one of curiosity, but also extreme caution and continuous learning. Start small, stick to the big platforms, and never ever invest more than you can truly afford to lose. The potential is huge, but the path demands respect for the risks. If you found this guide helpful, make sure to subscribe. For trending topics and actionable crypto insights, visit our website at generationalwealth.biz. While you're on our site, visit the shop and grab a free copy of our Generational Wealth Crypto Blueprint and Beginner's Guide to Altcoins absolutely free. Thanks for watching. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.